Hi friends, welcome back to the Big Joy of Learning with Bijoy Ji. Let's continue with Money Matters Simplified. In The Language of Money, today we are discussing net working capital, the short-term financial health. Ever wondered how to assess a company's ability to meet its short-term obligations? This brings us to net working capital, a key indicator of financial health. Let's explore what it is, how to calculate it, and why it matters. Net working capital is the difference between a company's current assets and current liabilities. It measures a company's liquidity and short-term financial health, indicating its ability to fund operations and respond to financial stress or opportunities. To calculate net working capital, subtract current liabilities from current assets. Net working capital is current assets minus current liabilities. For example, if a company has current assets totaling 2 lakhs rupees and current liabilities amounting to 1,50,000 rupees, the net working capital would be 2 lakhs rupee minus 1,50,000 rupees, that is 50,000 rupees. This positive NWC indicates that the company has 50,000 rupee more in short-term assets than short-term liabilities, suggesting good liquidity. Current assets include cash and cash equivalents, readily available funds, accounts receivable, money owed by customers, inventory, goods available for sale, prepaid expenses, payments made in advance for services or products to be received in the future. Current liabilities encompass accounts payable, money owed to suppliers, short-term debt, loans and obligations due within a year, accrued expenses, incurred expenses not yet paid. Interpreting net working capital involves understanding its implications. Positive net working capital indicates that current assets exceed current liabilities, suggesting the company can comfortably meet short-term obligations. Negative net working capital means current liabilities surpass current assets, potentially signaling liquidity issues and challenges in covering short-term debts. Zero net working capital implies that current assets equal current liabilities, indicating a neutral position but leaving little room for financial flexibility. Maintaining an optimal net working capital balance is crucial for sustaining operations and supporting growth initiatives. Effective net working capital management involves accelerating receivables, implementing efficient collection processes to receive payments faster, optimizing inventory levels, balancing inventory to meet demand without overstocking, extending payables, negotiating favorable terms with suppliers to extend payment periods without harming relationships. By optimizing these areas, companies can improve liquidity and ensure smooth operational funding. Maintaining an optimal net working capital balance is crucial for sustaining operations and supporting growth initiatives. Net working capital is a vital metric for assessing a company's short-term financial health and operational efficiency. Regular monitoring and proactive management of net working capital enable businesses to maintain liquidity, meet obligations, and seize growth opportunities. Continuing with the topic on language of money, we'll talk about some key financial terms everyone should know. Financial literacy begins with understanding the language of money. See you soon. This is Darpana signing off for now. If you found this helpful, don't forget to like, share, and subscribe to The Big Joy of Learning. Money Matters Simplified. Learn, grow, prosper. Have a big joy of learning.